Que pasa, dirty apes? What's going on, everyone? All right, we're gonna start a volume masterclass. A lot of you guys know I trade volume. I'm primarily a volume trader, and I've added certain things to my repertoire like harmonics, SMC, and other liquidity concepts. But today we're gonna focus on volume, and I'm gonna try to condense it in a digestible way without trying to confuse anyone or become too esoteric. The idea is any type of TA should be easily explainable to a newbie, and if you get too complicated with TA, it tends not to work out in practice. So the idea is I just want to give you guys a broad concept of what volume trading is, and we're using this as a primer, and we're going to try to expand on it with a few more sessions on this. So today we're going to go over the visible range profile, or VPVR, a lot of you guys know, and there's a fixed version and then a composite version you could use. So the composite version you're looking for in TradingView, I think it's VRVP, yeah, visible range volume profile. So I have it here, and basically what it does, it locks into your screen left or right side, and if you zoom out, anything visible on your screen it accounts for within the volume profile. Whereas if you use a fixed range, let's say here, you go into the 5th or 6th tab, and the same one you would use for longs and short, you're going to go to fixed range volume profile. I started just because it's super important, and then you're going to essentially pin it between a range. So you're looking for a range high and a range low within the price action. And the idea is you want to get equal highs, equal lows pinned within the range when you're trying to assess what that range value area would be. Now, the way I have it set up is a little different from the stock settings. So if you double click on it, all I've done is I've changed the value area color just so it visibly stands out, and I've changed the opacity and color outside of the value area because I'm not as concerned with this range or this range. I'm more concerned with the middle of the range where the highest distribution happens. So this specific this one for Phantom is not as clean, but the volume profile usually has this typical bell curve that everyone's familiar with, where you're going to have 68% of the volume distribution in this area, the value area. So the idea is to focus on what the behavior of price action is in the value area, and when it exits, how does it behave on either end, to the downside or upside. So we're going to use that on this chart. And the only settings that I've changed really is the color. This stands out, and then the opacity and the color here. Like I said, visually you don't want to see it, and then you don't want to see it as much. You want to focus on the value area. And then this, I think, comes stock 2000. I just didn't like the way it looked. It looked a little bit too granular for my liking, so I changed that to 700. And on high time frame it tends to look the way I want it to. So it's up to you what your preference would be. Now the key thing with volume profile is you're going to have a value area high marked in. And again, that's going to be this right here. So if I check that off, you notice that line disappears, right? Value area low. If I check that off, you can see that disappears. And then POC, point of control. This is where the highest volume distribution happens. So buys and sells it's accounting for. This is usually a pivot point within the price action, and it's an area of support or resistance depending on the trend or rotation of the market. But the idea is this is where the highest amount of participants within the chart are participating with the asset. Then you're going to have within that histogram high and low volume nodes. So you're going to see here, this is the highest peak of the histogram outside of the point of control. You could call this or consider this cluster here a high volume node, but for simplicity's sake, we're just looking at it as the point of control here, and this would be a high volume cluster over here. So depending on the context of the price action, this is an area where you're going to get chop once you're within it. But anytime you get acceptance above or below, then you're going to start developing more than likely a trending market in the direction that it accepts. So that's your high volume node. And then here you'll notice low volume node. These two histograms, it just shows that there's less participants trading in this range, 39.49 cents and 38.37. So in that range, it's pretty thin volume. And the rule with this is if you're in a market where price is descending from above and it's hitting this high volume node, typically you get deceleration in this area right here. So what you want to see is if you're trying to play the reversal trade, like if you're a position trader and you're trading the reversal, you're looking for a lot of resting bids to get hit here and then a deceleration in the trend down in this general range at the high volume node. So that's how you would use it in context of the price action. Vice versa, if you're coming from below and you hit that high volume node, usually you're going to get that deceleration here, and then you're going to have a lot of offers stacked in this range, and then they tend to sell off on first contact. But if you get a scenario where it kind of consolidates below the high volume node, then accepts, and then backtests the top, you can expect expansion. And then this would be a consolidation below resistance before the breakout. So that's how you would treat the high volume node. Low volume node, typically when the trend is strong and you enter a low volume node, I mean, you could really expand from here to here. This is the lowest histogram island within the trend or the bell curve. So typically, if you're in a downtrend, maybe you would stabilize here, accept below, then you get acceleration usually in the low volume node until you hit the point of control, and then you should decelerate again here. So that's pretty much the way you would treat the low volume node. It's an area where if the trend begins and people start not stacking, but piling into the short, and it enters the low volume node, this is an area where not much volume is traded. So the trend should accelerate in that direction within the volume node, low volume node. So that's a brief primer on how to use the volume profile. Now we'll get into pivot points, chop zone, acceleration, and deceleration. Just some ideas. We already went over how the pivot points work. So basically, you're in a drawdown, you hit that high volume node, you're looking for it to pivot off there. So that's an idea of a pivot point. The other thing is, let's say you accept below and you reject here, your next point of contact is usually the point of control, and you want to see this behave as a pivot point. Also, if you come from below the value area and you enter it and then you hold that value area low, this becomes a pivot point into the point of control. So the main idea that I want you guys to take away from this is that if you enter a value range, once you get acceptance, you basically create a pivot point until the next pivot point. And that's how that works. So this would be a pivot point at the value area high. This would be a pivot point at the point of control. This would be a pivot point at the value area low. And then basically your move goes like this until it reverses eventually. The market's always seeking equilibrium. So anytime you deviate from equilibrium like this, there's a mean reversion usually once the expansion is done and let's say overbought here in this range, then you'll get a mean reversion back to equilibrium here. Vice versa, if you get oversold, at some point it'll hit an area of value where participants see value in the asset traded, and then you get a mean reversion back to equilibrium. But the market is always looking at these dislocations of premium value, and then eventually participants will start selling off in premium and buying in value until you hit that equilibrium. So that's the way to look at supply and demand, and the way the market auto-corrects by way of participants trading volume. So that's your volume profile. Now we're going to get into more AMT or auction market theory, and then just try to establish core concepts behind that. So here's your bell curve, right? We already talked about this. 68% of volume traded in that range. The way I want you guys to look at it is basically like your value area high is one level, value area low is another, and point of control is another level. If the market is entering the range from above, let's say this is a value area on the composite volume profile, and we're in a declining market, strong trend down, we enter the value range and then we back test the value area high. If you get a moment of weakness, or a sign of weakness over here, it typically will sell off and then seek the bottom of the range, the value range. This is what we call rotational market, where basically price came back into the value range, rejected the premium within the range, and then went after, or it sought the value area at the bottom. So this is a rotational market. We'll go over live examples. Actually, the link chart is perfect. It has examples of everything. So that's your first type of market, rotational. Then you have a chop market, where basically you're already within the value area and you're chopping between the three pivot points, which are the value area low, point of control. Once you get acceptance above point of control, you're targeting the value area high. And then unless you can get a successful auction above the value area high, then you're likely going to come back and test the point of control or the value area low. And in this case, you could see it just rotates between each pivot point until eventually you get acceptance and you get a successful auction where buyers will outweigh the sellers and then push the price in whatever direction they see value in, or a trending market. So that's your chop market. Then you have a strong trending market, where basically maybe you are already coming in from above here. So within context, you were already in a drawdown. Then you entered, or you created a new value area range where people started participating within a range here. So let's say this is your range low, range high, and this is your mid, the 50%. In a strong trending market, it will enter the range and then not even back test the value area high, and it might even rip right through the point of control and completely rip through the value area low. In this case, this is a really strong downtrend. What you're waiting for is the back test once things get a little too heavy and oversold and they come back for a corrective retracement. You're waiting to see how within that range it behaves at the floor, the value area low. Or inverse, if you flip the chart and you have a strong uptrending market, if it breaks right through the value area, how does it behave when it does a corrective retracement back into the value area high? If it holds and it shows a lot of support, where you could see on the histogram the volume spikes again, then you're anticipating a push in the strong trend or the direction. So that's your strong trending market. Next, you have a mean reverting market, where basically you're in trend, but again, it's kind of like the strong trending market, except it will rip right through the value range, mean revert somewhere around the 50 fib. So if you again use a range fib, here's your 50 fib and it sits around the point of control usually. Then your mean reversion is basically anyone who bought here with the intention to distribute in premium, they're going to start distributing here into strength. So when all the apes start buying that green candle, that massive green candle at the top, that's where you get the volume blow-offs at the top. And then basically you get distribution into strength back down to the 50 fib, which begins discount. And so they're selling at premium. They're selling in premium and buying back in a trend at the mean reversion of the 50 fib, somewhere around the point of control. So that's how I would interpret the mean reverting market. And then your last one is a consolidative market, where basically you have your established value area, you're within it, and you test from the value area high or low to the opposite end of the value area. And then you get this bouncing ball effect, let's say. It doesn't even have to be a bouncing ball, like this could be higher, this could be lower. It doesn't really matter, but I just drew it for simplicity of the example. So you get basically this bouncing ball effect where they create a fake floor over here, or basically, you know, they give the impression that this is going to be support, or it is maybe a demand zone, who knows. But then the idea is there's a manipulative move, and then they go back into the range, and this would be essentially like your PO3, where you are within the value area, you're consolidating before the manipulation move down outside of the value area range, and then that's usually taking out a high time frame liquidity point or a high time frame PD array, and then going back into the range, accepting, and then creating your expansion, which is going to be the third part in a power of 3. So that's your consolidative continuation. And again, the key is within the name, consolidative continuation. The downtrend is established. You consolidate above what people deem to be support, and then it continues strong without a back test of that floor. But that can come up as a manipulation, or it could be a continuation of a much stronger trend down. So that's something to watch again. All right, so those are your different variants within auction market theory of how to use the visible range. And we'll get into next a live example. So here's one with BTC. So on that bull market cycle where we broke 20K and then started to rip up to 69K, we had, going into it, if you just take a visible range from the COVID lows to this consolidative range over here, and this is why I like fixed range profile, because if you use the composite profile, it's basically mapping everything on your screen. But if you want a very tight range that you're tracking, for instance here, COVID low to the high, that could be one, or COVID low to the high to the 50 fib around here, where you see this consolidative range. You can see thin liquidity node right here, thin liquidity over here, and all the distribution is here. So I call this the chop zone. This is basically where you're going to be ranging after an expansive move in either direction. We basically hit a local top and then impulsed into that chop zone. And then when you zoom in, if I go on the 4 hour, 12 hour, it's going to be more detailed, but just for this, you can anchor, let's do 4 hour in this range. And again, this video is very lightly planned. I just have minor notes of like the topic I want to cover, but this is all impromptu pretty much right now. So going into this, you do have the value area or a high volume node over here, and then basically if you start plotting your visible range within that range, you can see this is your value area high. Here's a deviation, but when you accept back into it, you come right back down more or less to the point of control. So right here, point of control, then you get a partial decline, top of the range deviation. Once you fall back in and you reject over here, you seek the value area low again. So whenever you go from a high time frame, like a daily chop zone, which you've marked out in blue, and then you create a more local range over here, you're looking within that chop zone just to trade the range. That's the idea here. And you don't actually long outside of the range until, well, ideally you want to get into long at the range lows. But the idea is if you're going to long a breakout, you don't long here because you're at the value area high where you're likely going to get a lot of resistance. The idea is some people got faked out over here, but that was just a liquidity grab of this and this. You want to see a very strong back test of the value area high over here, where you can see it hit once, twice, and then you can see on this candle, you're starting to get momentum, and then you build a cluster, you break structure, and you start leaving the range. Because remember, this is your value area high within the range. Here you could see acceptance above, and this is the area where you can start taking longs, because now you're flipping this into support here, and you've left the chop zone, and you've left the value area high within that range. So then you could see on the 4 hour, it starts expanding up, and then it even retested over here, and then that's where a larger move to 69K happens. So that's how to play a range within that chop zone or high volume node in order to take a long for a more expensive move. And on the daily, you could see a clear back test right here. So on the daily, here's your fixed volume profile within the range. Here you hit the value area high once, twice, 3 times down. So almost like a 3 drives, but the second drive wasn't higher than the first, so it's not exact. It could be just like a 3 tap setup. And then on the flip side, you see you break out above the range and back test the value area high, accept, break structure, come back, retest for confirmation, and then run. So this is a really good example. Now, if we go back into another live example, you have Link. This is right now the best range setup I've seen ever. It's basically been in this range forever. So you could just look at this as a giant macro range from here to here. That's all range. And you could just literally trade the high of the range to the low, and the low of the range to the high. The only trick is with Link, it's very scammy. If you don't understand volume profile, these deviations will knock you out every time. So it's better to get the lion's share of the move when you have confirmation of a range reclaim or you're re-entering the range, but not to get too excited on the expansion moves. But here's one. So if we take off the actual chart, this is our value area. In a strong trending market, you could see we were outside of the range. We entered really strong, and we went from the value area low to the high, came back to the POC, retested the high, and then expanded. So this retest over here, you could see it basically created a daily order block, broke through this structure over here, and then didn't quite sweep the highs, made an equal high basically over there. But the point is, you could have, if you understood how to trade from the value area, you could have entered along over here once you saw this candle engulfing here and traded it for 22% expansion. You could see the strong move back down into the range, and then you create a chop market. So if I hide the chart again, you could see here's the Esper or drawing of what a chop market would look like on volume profile. You're basically testing all the pivot points. Value area low, point of control, value area high, back to the value area low, POC. So you're just ping-ponging in between each one. Here you could see Link doing it, value area low to the high, POC high. This one's a little bit of an anomaly. Deviation here, back to the POC, very choppy. So that's your chop market. It's very difficult to trade, but if you understand, liquidity concepts, you can capitalize in both directions there. So that's your chop range within the volume profile. Last one is a rotational market. Again, you're within a strong downtrend, then you break the range, you re-enter the range, reclaim value area low. Your target is immediately the PLC, but your actual target is going to be value area high, which you could see we hit here, and we even deviated slightly above to take equal highs over here. So if you combine it with liquidity concepts, these volume profiles become very handy when you're trading. And that again is going to be your rotational market. I just have this inverted. So like I was saying, you were basically well out of the value area. You re-entered it, reclaimed, and then went straight to the value area high, which is effectively what we did here. We were way out of the value area, we reclaimed it, and then we shot to the value area high. So a lot of people would have got shaken out here, but all that did was take internal range, liquidity, and then finish the move. So if you're trading on high time frame daily as a swing trader and you recognize this is a rotational market back into the range, then you would be trading from the value area low to the high for 25%. And then you would look for a sign of weakness, where you could see here, it came back in, retested the value area high, you had a tweezer top, fell back in the range, you just short it down to the bottom. Same thing, rotational market back into the range. And again here, it's just reclaiming levels. So this, I didn't mark it in as a specific type of volume profile, but all it did was reclaim the value area low, target the PLC, backtest PLC, and then target the value area high. But then again, you had another liquidity raid here, and all it's done is created outside or external liquidity between here. So eventually the composite operator is going to take all this liquidity back. It's just a matter of time, but this is the range, and that's pretty much how you would identify it on a live example. So this is kind of like a primer for how to treat volume. Again, I have some more advanced concepts we're going to go through on other sessions, but today was just to give you a quick primer on how to use volume profile and what the auction market theory is, and how to treat. Oh, actually there's one more thing we could go through. Let me go through this on the daily. I didn't really go through proper auction market theory, but we'll do that now. All right, we'll go on the 4 hour. So we're going to do a 4 hour range, and I'm going to give you a little perspective on how this works. God, I just got to find it. Hold on. Here we go. All right. So at the bottom of CRV, in this live example, we have our volume profile, and I'm only marking it in from the composite high to the range low, but technically I could probably move it down to that range. The only thing is, all this is manipulative. It's very thin, like you don't even have histograms up here. This is all thin liquidity, so I only marked it. I was able to mark it from the beginning, or when token launched, until the range bottom formed over here. So really that's where I'm setting the fixed volume profile, up to there where the breakout happened. So this, even though it looks goofy, it's because we're using a composite profile on a 4 hour time frame, so that's why the histograms are a bit wider. But the real true value range is over here. So this is where the majority of price action happens. So if I just box out that range, you could see these are all deviations outside of the range. These are all manipulations, basically. Let me just change this. This right here is another deviation from the range, and then a baby one right here. So you could see, just looking at this visually by the square tiles, you have most of your price action in that value area, and then you have some deviations below and above. Now within the range, this is backward looking, right? So, you know, in real time, you're going to assess it differently. You wouldn't have a point of control yet. This would be your first interaction over here, and then it would become your naked point of control, meaning it hasn't returned to it yet, but this would be your first interaction with that naked point of control. So here you have your point of control. Here you have your first interaction with it. You could see it just raids liquidity and then zaps right back down. So it kind of shows you that within this range, once you reclaim the low, you test the POC, and then it's just behaving as a pivot point. So you're pivoting from the range or value range low to the POC back to the value area low. Here it basically falls through and rejects it, so that behaves like an SR flip, and then back tests your check back and then moves down, but it never breaks the low. Instead, it comes back into range, back tests it and holds, so your target becomes POC again. So if you just understood that concept on a higher time frame, you could trade from here to here 51% move. Vice versa, once you already have this point of control earmarked on your chart, then all you would do is wait for the value area low to be reclaimed. It moves back to the POC. Once it raids liquidity and shows weakness, you can then short it to the value area low, 33% move. And then, you know, obviously you would cash out here, but you would leave a runner and you would probably capitalize on this overselling. So 49% total move. Now, this is your range point of control now, so you know that there's going to be sell pressure if it returns again, and it does. Third time, hits it, sells off. So if you sold off here, you'd have a 20% move. Then you get a partial decline. So I use this as a potential momentum shifting structure. I know I posted today one on Solana, but the idea would be you have your established low within the range value or value range right there. Then you have your lower low here, kind of like an accumulation manipulation right there. And then you have your higher low over here. Actually, this would be your partial decline. You could call it this too. Yeah, it's not as clean, but the idea was this would be a reclaim of this microstructure right here, and that would be your momentum shifting structure right there on the partial decline. And if it holds, then you could position for a long over here to the value area high, 53%. So that's kind of the way you would play that. The same thing happens over here before breakout. So again, if you're playing the range based on volume, here's your established low, your lower low, zapping liquidity here and here. Then you basically hold the value area low, and you could see consolidation over here and then run to the value area high. It then makes a partial decline over here. This is a clearer example than the one over here, but the idea would be it's kind of like an inverted head and shoulders or inverted Quasimodo or bullish Quasimodo pattern. But the idea would be it's a momentum shifting structure. Low, lower low, taking out liquidity, higher low within the range value. And then once you hold that POC, you can see it pins it right there. You get one more push up here to the value area high, and then you form this 4-hour imbalance, engulf, and the momentum's so strong you leave the range, and then this is technically your range retest right here. So you can see it's so bullish, it shelves off of here, this area. It doesn't even hit it. It's so bullish, it just takes off. And then you get range, you get an expansion move leaving the range. So this was your value area range. This is your successful auction above the value area high. And the way that works is with auction market theory, you'll have DOM, or depth of market. That's just showing on the order books how many buys versus sells you have, right? So it's all perceived value. Let's say over here at the value area high, this is in premium. This is where people who bought down here are going to be distributing in premium into strength. So you might have, because you're so far above equilibrium, you might have 120 sell units. If we're looking at it like per unit, let's say 120 sells versus 100 buys. So you have an excess amount of sells because you have excess supply or people distributing at the highs. So because you only have 100 buys to absorb 120 sells, you have an excess of 20 sell orders, and that pushes the price back down because they've absorbed all the buy pressure and there's excess supply. So it falls back into the value area range. In the value area range, new value is found at this moment in time at 69 cents. So you have 20 more, an excess of 20 more buys over sells within the order book. And then basically they're absorbing excess supply in this range and pushing the price up. So at this moment in time, there's perceived value here more than sells that are on the order books. So then you push out of the range again. Here you basically get a liquidity raid from here to here. And because this was an old high from this area over here, you might have an excess in the order book of 140 versus 100 buys. So you have 40 additional sells. That's going to push it back into the range over here. And then here you get that you're re-entering, or like this deviation, you're re-entering the value area. And you can see 1, 2, 3 taps of the value area high. And then at this point, you might have excess sells still. So they're basically distributing at the top. And then that pushes the price back into value. Here you have a partial rise, works the same way like a partial decline. And that's a cue that there are not even enough buys to sustain the momentum into the value area high. So here you might have an excess of 2-to-1 sell to buys, and then you get excess sell pressure pushing it back to the lows. So again, here you have a liquidity raid. The idea is in the order books, you're now in value, deep value, and you took liquidity, so you're going to have resting bids stacked over here, and they're going to push it to the value area high. In this range, that's how auction market theory works until you get acceptance, meaning the buys outweigh the sells. So people are absorbing all the asks in the order book and willing to market in at that new price in time. That's when the price expands above the value area. So this would be an area where everything is in equilibrium. Right over here, you might have 100 to 100 balanced price right there. Then suddenly buyers flood in, and here you're going to have 140 to 100 sells, and then you get price expansion. And then basically sellers have been exhausted, absorption of all the asks have been complete, and you get a successful auction above the value area high. And then that's when the expansion begins. And then you get this glorious pump. And then that's the way it works. It'll come back into value area, form a new range, and then eventually you'll get acceptance above the range, and then you'll get a strong trending move or expansion. And that's the way it works in a live example. So hopefully this adds a little perspective and color to volume trading. Again, we'll go over actual strategies in a later session, but this one was mainly to give a primer and fundamentals of volume and volume profile. All right, guys, if you have questions, reach out, like and subscribe. Cheers. Have a great day.